financial asset that is completely outside of the system and runs no counterparty risk. You want to be preemptive. That's the point of gold for wealth preservation. This is what I use for my personal wealth preservation because it's out of the system. It's real. It has more functionality than any other asset class, and it runs no counterparty risk. Everything else is all counterparty risk.
Gold's outlook for 2024 is as promising as ever, with various economic and geopolitical factors playing a crucial role in shaping its trajectory. For investors, gold continues to offer a safe harbor in turbulent times and a valuable component in a diversified investment portfolio. The gold market is ending the week testing resistance at $2,050 an ounce, and according to some analysts, the precious metal still has room to move higher, as bullish momentum is just starting to pick up. Lynette Zang, chief market analyst at ITM Trading, notes that gold, unlike other financial assets, operates outside the traditional system and has no counterparty risk. She cautions against short-term market volatility risks, particularly concerning central banks utilizing CBDCs for control. Moving forward, Lynette foresees a breakout in the spot gold market, recommending this as a reasonable investment time while predicting higher prices throughout the year. According to Reuters technical analyst Wang Tao, spot gold may break resistance at $2,060 per ounce and rise into the $2,071 to $2,079 range. Meanwhile, Lynette cautions about the Fed balance sheet after repo market volatility, using the 2019 crisis as an example. The amount of money that investors are parking at a major Federal Reserve facility dropped below $1 trillion for the first time in more than 2 years. On Thursday, a total of 94 participants put a combined $993 billion at the Fed's overnight reverse repurchase agreement facility, used by banks, government-sponsored enterprises, and money market mutual funds to earn interest. It marks a steep decline from a record $2.554 trillion stashed on December 30th, and is the smallest sum since August 2021. Furthermore, she emphasizes the importance of being proactive during potential crises, advocating gold as a tool for wealth preservation. Now, we present the clips of Lynette Zang's insights from her recent video with ITM Trading Incorporated. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
In fact, volatility in short-term funding markets can hinder central bankers' ability to manage monetary policy. Oh my goodness! Don't worry, we'll let them bring out the CBDCs, the central bank digital currencies, and what do they say? We can have our finger on that button 24/7. You are going to be so off balance with anything they're doing unless you have food, water, energy, security, barterability, wealth preservation, community, and shelter. You need to get those things locked in. Do you answer this question for yourself. Do you want the central banks to have the ability to just at will? I don't. I want to be able to say to them, too bad, so sad. What you do, yeah, it's going to impact everybody. I'm not going to be immune, but I'm going to be more immune because I have especially the only financial asset that is completely outside of the system and runs no counterparty risk. Let's look at this spot market because remember, we've talked about these different toppings, right? 1, 2, 3, 3 tops. A fourth is 3 is a lot, right? Where it goes up, it hits its head, and then it comes back down, goes up, hits its head. So that's what they're attempting right now, is to further push it down. But the way that it works is really simple. When you have a spring and that spring is held down, so the spot price on gold is held down, when that's released, it shoots in a direction. And that's what it's been doing. And I would consider this, now this I would not say is a pervasive breakout yet, but I would say that that is imminent. So this is probably your best and least expensive time to position into this. Therefore, in this year, I expect much higher spot gold prices. And no matter what happens with spot gold, because remember, a rise in gold price is an indication of a failing currency. And so it benefits central bankers and those that are in power to suppress that spot price. But in the physical only, this is physical only market, we have seen at the upper echelons making way new highs. And even in the area that I personally buy into, still making this trend new highs. Fed's balance sheet leaps into spotlight after repo volatility because their attempt to run off the balance sheet led to the 2019 crisis. Now, they covered that up really quickly like they try and do, just what they did last March when the banks started to implode. They covered up really quickly, nothing here to see, just keep moving, just keep your money in the system so that when they finally bail in all of the debt-based assets, what are you going to do about it? You want to be preemptive. That's the point of gold for wealth preservation. This is what I use for my personal wealth preservation because it's out of the system, it's real, it has more functionality than any other asset class, and it runs no counterparty risk. Everything else is all counterparty risk. Okay, so the use of reverse repo facility fell by $313.6 billion on Tuesday. Traders look to this tool for clues on the quantitative tightening path. You gotta pay attention to this stuff. So this is the use of the Fed's RRP, reverse repo facility, fell, and look at how far down it's gone, and look at when it started to come up. It is down at 1 trillion from well above 2 trillion. Okay, you say, well, isn't that okay? Well, maybe, but Wall Street strategists have estimated balances at the RRP facility will be completely depleted by the end of the second quarter, at which point, this is important, at which point the central bank will be compelled to halt quantitative tightening.
During the interview, Lynette Zang warned about the Fed's challenges in unwinding its balance sheet and the potential loss of control over interest rates. As year-end volatility in overnight funding markets eases, Wall Street is refocusing on how much longer the Federal Reserve can continue unwinding its balance sheet without causing even worse disruptions. In preparation for possible economic turbulence, Zang underscored the importance of holding tangible assets like gold and silver for wealth preservation. Gold and silver prices are sharply up on safe haven buying in early U.S. trading Friday, following news of U.S.-British airstrikes against rebels in Yemen. February gold was last up $35.30 at $2,054.50. March silver was last up $0.52 at $23.225. Let's get back to the interview.
Forget rates. Now worry about the Fed unwinding its balance sheet, which means the Federal Reserve selling $95 billion worth of treasuries and mortgage-backed, mostly treasuries, but treasuries and mortgage-backed securities a month. Discussions come as funding markets showing signs of angst. Wow, okay, do you remember 2019? Because I sure do. They tried an unwind before. The last time the Fed attempted a balance sheet reduction in 2019 in the funding markets prompted a rethink. You think? Of course, because Fed printing is all they have. That's the only tool that they have. And so that is what's creating artificial liquidity in the markets. And when you take that away, there is no liquidity. So that's what happened in 2019, and you can see that this is where they are dropping their balance sheet. Now, they're still very close to 8 trillion in holdings on their balance sheet. But look at this. These are the deposits held by depository institutions. So those are going up a little bit because I guess March last year wasn't a big enough of a warning to say, don't keep your money in the banks. So, okay, let's forget that. I'm getting more interest, so risk your principal. Makes no sense to me. The Treasury account itself is up, but what's down? Reverse repos, right? And the reverse repos are the collateral. The treasuries, rather, are the collateral for this repo market, which is the underlying plumbing of the global economy. And a lot of that also comes from money market accounts, which most people think are so safe. Well, are they? I think it bears a rethink. Because right now, with what the Fed is doing, repo's era of calm is over as Fed pullback reignites volatility. They are between a rock and a hard place. If they do one, that creates this problem. If they keep rates high with this massive mountain of debt that is getting rolled over and government debt that is being issued, that means that's a lot more expensive. It's a problem. If they turn around, or I should say when they turn around and drop those rates down, then you've got free money again, money printing, and you've got inflation coming back. Now, will that force them then to raise rates again? They're between a rock and a hard place. It doesn't really matter what they do. We are at the end of this currency's life cycle. So overnight, general collateral repo traded as high as 5.6%. Just on December 28th. Look at that. So interest rates are going up. And what happened in 2019 and what potentially could be happening now is the Fed could be losing control of interest rates because they handed over trading to the markets. Traders don't give a crap about any of that. They just care about making a little bit of money. That's all. So what they're really doing is solving one problem, but then they're setting up the next problem. Which one will be the last straw? I'm going to be as surprised as you are when it happens, but I'm going to be prepared because I have my gold, my silver, my food, my water, energy, security, barterability, wealth preservation, community, and shelter. I'm hoping that you have prepared likewise. Otherwise, community becomes the single most important thing because you're going to be dependent upon a whole, well, I am too, dependent upon a whole bunch of people to bring their skills together to help us survive this mess.
Market conditions align for the gold market as the precious metal benefits from safe haven demand and growing expectations that the Federal Reserve will cut rates sooner than expected. As gold and silver prices surge following global uncertainties, the safe haven appeal of these precious metals is evident. Looking forward, how do you perceive the role of gold in wealth protection amidst evolving market dynamics? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.